Good morning. My name is Kimberly, and I will be your conference operator today. At this time, I would like to welcome everyone to the Iron Mountain Q2 earnings webcast. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. Thank you. Ms. Marsden, you may begin your conference.
Thank you, Kimberly, and welcome everyone to our second quarter of 2014 earnings conference call. I'm Melissa Marsden, Senior Vice President, Investor Relations for the company. This morning, we'll hear from Bill Meaney, CEO, who will discuss highlights for the quarter and progress toward our strategic initiatives, followed by Rob Day, CFO, who will cover financial results and discuss elements of our new supplemental reporting package. After prepared remarks, we'll open up the phones for Q&A. Per our custom, we have a user-controlled slide presentation available at the Investor Relations page of our website at www.ironmountain.com. Today's earnings call and slide presentation will contain a number of forward-looking statements, most notably our outlook for 2014 financial performance. All forward-looking statements are subject to risks and uncertainties. Please refer to today's press release, slide 2 of the supplemental reporting package, the safe harbor language on this slide, and our most recently filed annual report on Form 10-K for a discussion of the major risk factors that could cause our actual results to differ from those in our forward-looking statements. In addition, we use several non-GAAP measures when presenting our financial results. The reconciliations to these non-GAAP measures, as required by Reg G, are included in this supplemental reporting package. With that, Bill, would you please begin?
Thank you, Melissa, and good morning, everyone. This was a good quarter for the company, highlighted by the receipt in late June of the favorable private letter ruling from the IRS and our conversion to a REIT. As we've said from the beginning of the process, we believe we fit well as a REIT due to our sizable real estate portfolio. We have a very attractive business model through which we incur occupancy costs on a square foot basis and generate storage rental revenue on a cubic foot basis. This significant spread between our cost and our return on investment generates high net operating income per square foot and is core to how we create value for our stockholders. We also distinguish ourselves through low turnover costs per square foot. We have no TIs or tenant improvements required if a customer terminates and we bring in another customer's records. We also have a low customer churn of less than 2% per annum, as well as maintaining high-quality receivables given our service to 950 of the Fortune 1000. The REIT structure complements our strategy whilst enhancing payouts, and it highlights our highly disciplined approach around asset allocation. As a REIT, we expect to continue to generate the cash flow necessary to support attractive stockholder returns and to invest to sustain the durability of the business whilst continuing to identify opportunities for enhanced growth in line with our long-term strategic plan. We also see the potential to purchase a significant portion of our leased real estate over time, thereby reducing our cost of debt and enhancing residual values. The recent roadshow presentation available on our website addresses many of the common questions related to our conversion, so we're not going to spend a lot of time on that in prepared remarks today. Rather, I'll focus on what we're seeing in the business and the progress on our strategic plan, and then Rod will cover financial and operating specifics whilst directing you to the relevant sections of our new supplemental reporting package. Turning now to financial highlights, total revenue for the quarter was $787 million, up 4.4% on a constant dollar basis, with adjusted OIBDA of $242 million and adjusted earnings per share of 41 cents per share, up roughly 5%. These results were in line with our presentation during our Investor Day in March and demonstrate the same growth rate on a like-for-like basis, both as a C Corp as well as now as a REIT. We maintained our high adjusted OIBDA margins for the total enterprise of roughly 31% during the quarter, with consistent performance in our North American segments and international margins in line with our targeted level in the mid-20% range. In addition, we achieved solid operating results and are making good progress on our strategic plan to sustain the durability of our high-return business in developed markets, having added a net 1.3 million cubic feet of internal growth in the first half of the year in North America. Moreover, having reached 12% of our sales coming from emerging markets by the end of Q2, we are on track to our goal of having 16% of our sales from this high-growth segment by 2016. Finally, we continue to identify and test new and emerging business opportunities, as well as further scaling of our data center opportunity. Total storage rental revenue, the key economic driver of our business, was up 5.7% in constant dollars, driven by strong growth of 14% in our international business and constant dollar growth of 3.3% in North American Records and Information Management, or RIM. Storage rental internal growth of 1.6% for the quarter reflected solid growth in records management volume of 1.7% in terms of internal growth and 7.6% if we include acquisitions year on year. We continue to see improvement in retention in North America, where total records management storage volume outflows dropped to 6.6% from 6.8% in the first quarter and 7.1% in the fourth quarter of 2013. We are pleased with this progress, as the reduction in terminations, supported by our first quarter of net positive volume growth in North America Records Management since 2011. Importantly, we maintained strong North American Records Management margins of more than 38% during the quarter through ongoing productivity enhancements, whilst continuing to invest in strengthening customer relationships and product development. In our international business, constant dollar storage rental growth was about 14% overall, with 32% constant dollar growth in emerging markets. These emerging markets, which, as I mentioned, represent just 12% of our total enterprise revenues today, have very favorable growth dynamics. Emerging market storage rental internal growth was 12% in the second quarter, whilst volume expanded by 10% excluding acquisitions, or 33% in total, reflecting the successful integration of acquisitions completed in 2013. Acquisitions continue to be an integral part of our strategy overall, with a particular emphasis in these high-growth markets. We have a strong pipeline of opportunities in emerging markets, with more than 3 times the coverage needed to achieve our goal of growing this part of our business to 16% of total revenue by the end of 2016. We evaluate acquisitions in terms of how they can both further our market leadership and sustain the durability of our business after first establishing that we can exceed our cost of capital and achieve our targeted returns. During the second quarter, we completed a few small customer acquisitions in the U.S., as well as a tuck-in acquisition in Brazil, and closed the previously announced transaction in Poland, bringing us to about $60 million of company acquisitions and another $10 million of customer acquisitions year to date. Within our emerging business opportunity area, we are pleased with the early interest in our data center operations. We have booked more than 70% of the inventory space we developed in our underground facility and are kicking off our next phase of development there. Additionally, we have signed our first few small deals in our data center near Boston, which we just completed last month. It is early days, but we have a good pipeline building up. Our targeted segment of the data center market has good growth dynamics and the potential to generate very attractive returns, and we will continue to employ a success-based approach to investment as we look to scale this business. For the remainder of the year, we anticipate continued solid constant